Today's episode of Market Talk is brought to you by GrowMark FS. Keeping up on the latest in ag is a challenge to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And a good afternoon. Welcome into Market Talk here on this Thursday, June 2nd. Great to have you with us on the program today. Thanks for making us part of your day. I am your host, Jesse Allen. Find us online, markettalkag.com. That is our home on the web where you can find all of our streaming sources, radio affiliates, and more. Well, we had a bit of a turnaround today in the grain markets led by the soy complex and winter wheat. I have plenty to discuss today on the show. Let's dive right in and say good afternoon to our good friend Bryan Doherty, Senior Market Advisor at Total Farm Marketing. Bryan, good afternoon to you, sir. And after a rough couple of days, at least we got some green back on the screen here on this Thursday, Bryan.
Yeah, we did, and it's nice to see, just to give a little bit of relief to such a pounding that between wheat and corn, both finishing firmer today. Wheat, as you said, across the board, the winter wheat contracts finished with some pretty solid gains, um, anywhere from 17 to back months for next year, 32 higher in July, Chicago. So some real strength there. So hard red winter wheat up 15 to 25, and then spring wheat. Uh, not as much as I would have thought. They gave some back, about 2 to 5 higher there. The markets are really pounded hard, and of course, you come back from a 3-day weekend. The market has time to digest either new news or maybe the old news is kind of tired news. We've talked about this a little bit, but kind of get the corn toward that latter part of May, early part of June, you're just kind of in this what I'm going to call no man's land from a news perspective, weather perspective. What's planted is going to be planted. What isn't going to be planted. That becomes old news. The market focuses near term on the weather. There just usually isn't enough weather, either brutally dry or just brutally wet, to really move it. And so then what happens is the market kind of gets this kind of gravitational pull. Um, the point of it is that you don't really need any news to allow a market to drift or slip, but you need generally something to feed the bull, keep it moving. Um, that was pretty hard Monday and Tuesday, though. So it looks like we broke some support levels and it really uncovered a lot of sell stop orders. But what I think was really behind this, there's two things. One is this continuous talk that there could be some resolution to grain moving out of Ukraine. The more I read, the more I want to believe that there's not a lot of belief that's going to happen.
Mm-hmm.
Maybe it can. The other thing is just you got rather kind of benign forecast. The rain makes grain crowd kind of took over, and the funds really moved out of a lot of positions, and they were probably rebalancing some of their overexposure to commodities. And I think we're actually just trying to maybe establish more equities. If you look at those two charts, the equities basically went straight up when the corn and wheat markets, the last couple of weeks in particular, have been moving down.
And I think that's a great observation because it felt like to me we saw a lot of the funds just liquidating their positions. Plenty of spec funds going long. It looks like in some of these contracts as well here as we move into this month of June. And to everything you said with your point, it is a little bit of that no man's time frame here with just kind of trading, you know, old news that's not fresh and or waiting for any fresh news, Bryan, and seeing some of that money flow back into the stocks and the equities. It seems like it's maybe just a case of some of that New York money kind of deciding, okay, it's time to move our money somewhere else for a little while.
I'm guessing at all of this, of course, but I think there's a little bit of where there's smoke, there's fire. I think there's a little bit behind all of that. The technical picture got damaged a little bit.
Mhm.
So I think there were a lot of sellers that were selling not because they thought, oh boy, I better be a seller, but the market goes down and uncover those risk orders. And when you have a prolonged uptrend like corn has, and then it kind of flared out, went sideways, and sort of tested the same lows several times. That once you break those lows, um, you know, everybody sees where those are in the charts. You can put a sell stop and futures under there. That is an order that does not trigger until the market touches or goes through it. So those who maybe want it to be, long the market, were in, and that was how they managed their risk or their gains. And then there could be also that you can, in commodities, you can start a futures position with a sell stop. So could have been a lot of people said, look, I'm bullish corn, but if it tips over, I need to be a hedger or I need to be a seller because I think it could drop off. So that's another type of selling. So on the way up, if you might remember, we talked about three kinds of buying. We talked about short cover buying, we talked about speculative buying, and then we just talked about investors that are buying as the market breaks new highs. Here you almost got the opposite. You got liquidation selling, you got sell stops that are triggered, you've got hedge pressure, and you maybe have there might be some farmers that said, you know what, I don't want to hang on to this green, for the next 3 months and find out we're another 50 or 60 cents lower. So I think you might have moved some product into the pipeline too.
Very, very true. And as well with the corn market, some of that technical damage we've seen on the charts. I've seen some folks, talking a little bit about, we're getting to those 100-day moving averages. Some of those we haven't seen in months. If we, keep trending lower, break through those levels, I mean, it feels like we have a lot of air under this corn market to maybe give us more downside risk right now. I don't know. What are your thoughts on that, Brian?
I think in the big picture you do. So one of the things that I like to remind farmers is that wherever the market peaks, if we look back from a historical perspective, there's downside potential or risk, and generally we find, or I found that about 20 to 25% of what the market will give up from some sort of winter or spring high to wherever the late summer or fall low is. And so if you take, for instance, 765 corn, take 80% of that or take 75%, it gets down that $6 window or lower. So that's um that's something that we certainly want to, highlight as, at some point bull markets start to bear markets. And so we're kind of at a real pivot point. Some will argue this is just a correction. If it is, boy, you got a chance to buying cheaper. But if this doesn't hold, now you're talking about that air under the market. And I just want to double check my math on that. But on that 765, I take 80% of that. Yeah, it's a 612 downside objective. And if I take the inverse of um, 25% drop, which is 75 times 1 point, that gives you about a 575 downside objective. So I just want to do the math to double check that because that's really important to know. History's proven that to be fairly, accurate. So if we do have a good crop, don't be surprised if we're in that 550 to 6.25 area. Probably, more toward 550, $6 where we started this rally from here back in the fall.
Very true. I want to talk to the soybean market a little bit here today. That was the leader to the upside, and we even saw strength there yesterday while corn and wheat sold off. I know bean oil, big moves there today. Heating oil higher. I mean, just a lot of different things in the soy complex. Plus that sale to Pakistan, an unusual buyer of soybeans coming in on the wire this morning. A lot of things that felt like under the soybean market today.
Yeah, there is. Now, sell like that, it just, as you said, it's not something we typically see. So when you see that, it kind of tells you there's some positioning and maneuvering, and where we're going to get our inventory. Let's get it bought sooner than later, before we get to weather market, or we're tight in supply. It all goes back in the soybean market to the drought in Brazil, and you come into this winter season in Brazil and Argentina with limited supply. And so while the world's going to gobble that up, it still needs it. There's a limited amount. So U.S. exports are running ahead of what the USDA has already projected, actual sales on the books. So there'll probably have to be an adjustment upwards. So that's, to me, kind of the catalyst underneath the market. But which is the export sector. But the other sectors, what you mentioned, the energy sector, boy, there's just conjecture that this energy thing is not going to solve itself soon. Um, and soybean oil continues to march right in lockstep with it. Had a bit of a correction here the last 30 days, but it wasn't that steep. And a really strong breakout today over the top of a downward channel line in the oil. So it's still looking like the need for beans by the end of summer, early fall is critical. We'd heard, and I want to highlight heard, some talk of about $1 to $1.50 premium for early harvested beans on the September contract, which is quite amazing because we're still seeing the inversion in the market there. So the market is telling the rest of us that this supply pipeline will, it'll be volatile, but it's tight. Um, Prices will be jumpy, but supply is tight.
Well, and to your point about some of those bids, I've heard some of those same things as well, with some pretty impressive bids across the countryside as we look at the cash market, whether we're talking corn or beans. Hearing some of these rumors, some of this talk about this, and I think it just goes to show overall the tightness of the balance sheets and how things could be looking as we head into the fall, as we start to get in the growing season and look towards harvest, that we could see more of these cash bids that are substantially above the market.
You sure could, and I think you sure will. It just there's no room for error in these crops, and I know last year we were talking when projected carryout for beans in midsummer was 100 million, and we just said, look, there's no error or no room to error, and then carryout grew because of some things, but
Mhm.
um, we're really backed into a corner, not only the United States but the world. So I kind of wonder what this might look like if China hadn't been so hard on their lockdowns, because that seemed to kind of put a skid on everything. And now that they're coming out of lockdown, maybe the bean market is somewhat reflecting expectations that they'll continue to be a ravenous buyer, maybe more so for new crop delivery. Rumor continues to kind of circulate Brazil could be out of beans by August. And if that's the case, well, there's not too many go-to markets other than the US. And that might be the rationale behind the high bids for early harvested beans.
Very true. Very true. Let's talk livestock. Another solid day in the cattle markets here today, Brian. Hogs were a little more mixed, but overall, we look at the livestock trade after Memorial Day now. We're getting into summer grilling season time frame, looking at various factors. But I was impressed with the way the cattle market settled up here today.
Yeah, and particularly the feeder market showing a real reflection of the corn market losing value the last couple of days. And feeders have probably been, I think, to my liking, probably a little bit unduly punished. And it doesn't take long to kind of snap out of it. Now they're still undervalued from my perspective. When you look at what we think will be very limited supplies down the road. Um, Cow slaughter up on the year. You're looking at that. You're looking at the grilling season. You said China coming out of lockdown. Um, Cattle market is undervalued from, I think, our perspective. Um, Cow on feed numbers show lots of supply near term, but the market's going to work through those supplies relatively quickly, I think. And then we're going to be left with this back back month scenario where there's a big carry. Unlike the bean market, you're going to see the carry go really on the deferred months, and that's already been, to a large degree funneled into prices, but still, I think that could go a lot more. I think especially midsummer or midwinter contracts. April had a nice hook reversal a couple of days ago. Inside day yesterday, nice move higher here, trading, let's call it 154. Contract high about 158. So when you think about all this kind of stresses and strains the cattle market's kind of had here the last couple of months, with grain prices, rocketing higher and whatnot, um, all of a sudden those deferred months, they're $4 off their high. I wouldn't be surprised in the next several weeks if we don't see new contract highs established on deferred months.
Definitely something to watch. Hog market as well had a big day yesterday. Today, just maybe quiet, maybe taking a bit of a pause here as we head towards the end of the week, Brian.
And it kind of looks like it. I think the market's trying to figure out, again, if we, once we reach the 112 level, is that too much on the futures market until we see it in the cash? Um, I want to think too that when you look at the product market, you look at the export sales, you look at the what I guess we'd call direct sales. Um, it's not negative for hogs. There's just nothing on the radar that's negative. And that doesn't mean they can't go down, but that's why they've rallied here. They're just when you align, I think the variables, they're all aligned toward recovery and price. We had that real textbook head and shoulders formation in the summer month contracts in particular. The market fulfilled that, went down and turned on a dime here. I'm not necessarily bullish from here, but I'm growing less negative on anything hogs.
Brian, as well, let's get an update on the dairy markets here as we are working into the month of June. What do you see in there as we wrap up the week?
Well, it looks like the June contract will settle up with the index somewhere around the 24.30 mark, so we can expect that. And then as you look out a little bit, you've got $24 milk all the way through October. So each month between now and October, back months are all solid above 20, 21, $23. Um, it's this is a multifaceted. I don't want to say problem. It's a multifaceted. I'm going to call it problem. With the dairy industry, you got high feed prices right now. You've got good demand, um, but I don't think you've got, and we've talked about this before, the economic structure to grow the industry rapidly. So that means for right now, we probably stagnate. I think our USDA, cow numbers, milk per car, all of those things um, continue to be something that we'll need to, I think, anticipate will hold milk prices higher than they typically are and bring the back months probably up in that $24, $25 area as well.
Brian, great analysis as always, sir. Any final thoughts for us on this Thursday?
Well, I'll tell you, it's been a volatile week, and I think if I could just kind of remind people, it's not to rub it in the wound and the salt, but when you get to higher levels, keep making some incremental sales, looking at things. Um, and the drop off of what 50 around 50 cents on corn futures in 2 days, 2 days, just 50 cents. So all the bullish news seemed to evaporate. So just always be kind of thinking that the market can, especially after a rally, can really unravel quickly and fast. And in my studies, when we talked about earlier, we talked about these percentage changes, 20, 25%. Usually they're within a short period of time, short period being like a month to 3 months. I mean, when they happen fast and hard. So you got to be there to catch it. So just consider that, don't hesitate to keep selling into rallies if we get them. Right now, if you're behind sales, I guess I'd keep it in perspective and say, hey, you got an opportunity to sell corn near $7. If we were on the way up, you'd be tickled with it. You're disappointed because you're on the way down right now.
Good things to consider. Brian, if folks need some advice with their marketing too, I know they could reach out to you and the team there at Total Farm Marketing very easily. What's going to be the best way to do that?
Best way is just give us a call, 800-334-9779. If you want to talk to me, ask for Bryan with a Y.
Fantastic. And I know as well you can find the information online at totalfarmmarketing.com. With that, Brian Doherty with Total Farm Marketing. Appreciate the time as always, sir. Have a great rest of your week and weekend, and we'll talk to you next week.
All right. Very good, sir. Thank you.
Brian Doherty with Total Farm Marketing joining us today here on Market Talk. That's going to do it for the show on this Thursday, June 2nd. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.